Hello and welcome. The topic we have for today is time value of money. All right, so first let's talk about what we will cover in this particular reading throughout the reading. So we will discuss the concepts first of time value of money, what it means. We'll try to understand. In short, we may call this as TVM, time value of money. So our first topic will be what is time value of money, what is TVM. Secondly, we'll also talk about some basic terms and the interpretation of interest rates. So we'll talk about interpretation of interest rates. We'll also look at, and that's going to be our main component, or that's where the most of the effort would actually go in this reading, is how do we actually calculate the future value of cash flows and how to calculate the present value of cash flow. So most of our effort would be in this particular area. And finally, an important section as well, which is how we would actually solve and calculate for the rate of return, which is called R. How do we calculate the number of periods and the size of annuity payments? These are the things we would also look at towards the end of the reading. All right. Before we get started, we need to understand what does time value of money actually mean. So just to sum up what this reading would actually cover, here is how you could actually look at this. Let's suppose that today you are investing $100. So this is the amount of investment you are actually making. All right. And the return that you're expecting on your investment is 5%. So let's say that R denotes for you your return, and that is equivalent to 5% on an annual basis. That means after 1 year, you're expecting that your $100 will grow at 5% to become 105. And the way we could quickly calculate this is, one way is you take the 5% of 100. 5% of 100 is $5. And you add $5 to 100, and that becomes 105. Or alternatively, what we could do is we could say 100 into 1 plus 0.05. Right? So what we are saying is, where did the 1 come from? 1 is our base investment. So if we had invested $1 here, then it will become 1.05 after 1 year. And what that means is, if $1 becomes 1.05 after 1 year, then $100 becomes 100 into 1.05, that is 105. After 2 years, how much would our investment become? Now, here's an extremely important point that you need to remember. The assumption we are making here is that we are going to reinvest our return for first year, meaning we are not only investing the original $100 for the second year, but we are also reinvesting the $5 we earned in the first year. Hence, our value in year 2 would be dependent upon the investment size at the beginning of year 2, which is end of year 1. So this would grow, which means 105 would grow again at 5%, which is 1 plus 0.05, to become $110.25. So this concept whereby we reinvest our cash flows, and in the second year, if you notice, we earned more than $5. In the first year, we earned $5 on our investment. In the second year, we earned $5.25. The extra return that comes 0.25 is because we earned 5% on the $5 investment. So all in all, we invested 105 and we earned 5.25 on that. This may be called interest on interest, or the return that you get because of reinvestment. This concept is called compounding. So we're saying that our returns are actually compounded. All right. So we could rewrite, or we can get our value after 2 years. We can rewrite this in this way. We could say the $100 that we invested at time 0 grows at 5% after 1 year to become 105. And then the 105 gets reinvested again at 5% to become 110.25. And this is the value we get after 2 years. We could again rewrite this as, we could say, $100 into 1.05 to the power of 2, and that gives us 110.25. 5. The $100 that we are investing today is called present value. And here we have derived a certain formula, which we would continue to look at throughout the reading, times this part of your equation is actually 1 plus rate of return. That's what you see right here, to the power of what you see right here at the top is n, which is number of periods. And that should give you the value in the future, in this case after 2 years, which we call as future value. And this is the present value at time 0. So we have derived a very important relationship here. In other words, if we know our present value, and if we know the rate of return, and we know the n, which is number of periods, we should be able to get the future value. And this simply sums up what we will actually cover throughout this reading. As we said earlier, we'll talk about how to calculate the future value first, then we'll talk about how to calculate the present value, then we'll also learn how to calculate for n and r and so on. So that's what we will actually be talking about throughout the reading, and this will be our formula that we would be using over and over again in the whole reading. Now, one key point to note here is when I say R, is R your annual rate of return, or is it actually periodic rate of return? R is not annual rate of return. It should be your periodic rate of return. Meaning, by default, whenever you are given interest rates, they're always given as annual until and unless explicitly mentioned, which is generally very rare. So you would always be given annual interest rates or annual rate of return. However, they might tell you that you would earn, while you would be earning, let's say 5% on a quarterly basis or on a quarterly compounding basis. That means the return would be credited to your account every quarter and then reinvested every quarter. In that case, you would have to adjust your 5% annual rate and make it quarterly rate of return. So you would have to see how the periodicity is being defined in the question. Is R being defined, or is periodicity being defined as annual in years, or is it being defined on a quarterly basis, or on a monthly basis, or on a daily basis, and so on. So you need to pay attention to that. And if the compounding is quarterly basis, then the R should be quarterly rate of return. Or if compounding is on a monthly basis, then R will be your monthly rate of return, and so on. It could also be daily. It could also be semi-annual rate of return, depending upon the periodicity. Likewise, N, and I always say two things are periodic here. R is periodic rate of return, and N is number of periods, not number of years. So if it's quarterly compounding, number of periods each year would be 4. If it's monthly compounding, number of periods in each year would be 12. So if it's quarterly, this becomes number of quarters. If it's monthly, this becomes number of months. If it's daily compounding, this would actually become number of days, and so on. So make sure you know that these two things are actually both periodic in the question. They are not necessarily annual. All right, I'll come back to this formula later on, and we'll be, as I said earlier, we'll be looking at it several times throughout the whole reading. But let us now try and understand what does time value of money actually mean. All right, so let us say that I owe you $100. That means I need to pay you $100. And let's make two assumptions, two critical assumptions here. Number one, that we live in a world in which there is no risk. All right, so there is no risk and no inflation. So these are the two assumptions we would actually be making. Number one, that there is no inflation in the world that we actually live in. And number two, that there is no risk. In other words, if you have lent me money, or if you have given me money and I owe you money, you are guaranteed to receive that money from me, because there is simply no risk, and no risk of default, or no sort of any risk. So that's the world we actually live in. And going back to the scenario where we said that I owe you $100, which means I need to pay you $100. Let's suppose I give you two payment choices. Number one, that you take the money from me today. So you take the money today, which is $100 today. Okay, so I owe you $100. I'm willing to pay you the $100 today. And the second option I give to you is take the $100 from me after 1 year. With this scenario in mind, that we are living in a world in which there is no inflation and simply there is no risk. Would you still demand? Would you be willing to accept the second payment term, which is to receive the money after 1 year? Of course not. You would never ever accept this, right? Because why would you be willing to receive the same amount of money after 1 year when you can get the $100 today? Now the question is, why would you not accept $100 after 1 year? Let's suppose we know that in this world that we live in, there are some investments that are absolutely risk-free, and they're offering you 5% rate of return, which is very high, obviously. But let's suppose this is for our example. Let's suppose this is the risk-free rate of return, and now I give you two choices. So instead of this choice, I say, okay, let's just leave this option. How about this? I give you $100 today, and or you take from me 105 after 1 year, given that there is no inflation and no risk. Earlier, you would reject my offer because you can take the $100 today and reinvest and invest it at 5% for your money to become 105. And now I have given you actually the same deal. So if you take the $100 from me today and invest it elsewhere, you will still get 105 after 1 year, which is what I am actually paying to you, and you're guaranteed to receive that amount from me. And maybe in this case, you would actually become indifferent between these two options, right? Because every other investment out there in the world is also offering you 5% rate of return. This return that you are demanding is basically the value associated with time. You're not demanding this return for inflation because there is no inflation in the world. You're not demanding this return for risk because there is no risk in the world, because I don't have any risk. We are in an absolutely risk-free world. This is the return you're demanding for giving up your $100 today. You certainly want more than what you have actually given up at time zero. And this is referred to as time value of money. This $5 return that you demand for giving up your money at time zero, despite of no inflation and no risk, is called real risk-free rate of return. So your real risk-free rate of return actually represents a compensation for the time effect. And that is referred to as time value of money. Now, that we said that the return that you demand for the time effect is 5%. Imagine we were in a world in which there was no inflation, and imagine now what if there was inflation? Would you demand 5%? Of course not. You would demand more, because you would also demand compensation for inflation, because of inflation your money tends to lose its value. So in other words, you would not only accept 5% real risk-free rate of return. If we were in a world with inflation, you would also demand compensation for inflation, which is called expected inflation. Likewise, if we were in a world with risk, you would also demand compensation for risk premium. And that's a topic we would come down to in a while. All right, so having understood the concept of real risk-free rate, let's now understand what we have already basically discussed. The $100 we know is called present value, and the $105, which is the value of money in the future, is called future value. The rate of return that you're earning is called interest rate, which is 5% in this case. You may call this interest rate. You may also call this rate of return. And interest rate, which is the term that you will be seeing a lot throughout the reading, can have several different interpretations in different contexts. And that is what we would actually now look at. So what are the interpretations of interest rates? And how do we interpret interest rates? So the first interpretation is it's actually a required rate of return. It may be interpreted as required rate of return. Think of it like this. Let's say you are an investor who is interested in buying a bond. And of course, every bond that you would look at would have different risk. Some bonds would be more riskier, other bonds would actually be less riskier. Do you think you would require a same amount of return from every bond? Of course not. And the reason being is, as we said, because of different levels of risk. Some bonds will carry more risk of some companies, and therefore you would demand a higher return for accepting that level of risk. And the return that you demand in order to invest in that particular asset class or asset is called required rate of return. In short, we can say this is the minimum return you demand, or minimum return required by the investor. In order to accept a particular investment. The second interpretation of interest rate is discount rate. All right, so what is discount rate? Let's say I'm going to receive $105 after 1 year. And the rate of return that I'm earning is 6%. With this rate of return, how much is my investment worth today? Meaning, what is my present value today? What is the worth of this 105 today? In other words, all we would do is we'll take the 105, which is future value, and discount it at 6% to arrive at the present value. So in this case, the rate of return is called discount rate because we use it to discount the future value to arrive at our present value. And hence it is called actually discount rate. So commonly, the required rate of return, the term or discount rate is often used very interchangeably. The third interpretation of interest rate is opportunity cost of capital, or opportunity cost. Now, what is opportunity cost? All right, a simple definition of opportunity cost is actually the next best alternative that you forego, meaning that you actually give up, is called opportunity cost. The way you could actually understand this is, let's say if I build a house and I could have rented that house to earn a certain amount of rent. But if instead of renting out that house, I decide to live in it myself, what was my next best option? My next best option was to rent it out, let's suppose for $10,000. So the return that I actually give up, which is the $10,000, is called opportunity cost of me living in the house. In the same way, let's say if you have $10,000, and this $10,000, you have two choices to make. Either to spend it today, maybe for whatever it is, whatever you need, or alternatively, you could buy some bonds that would actually earn you, let's say, 5% return. If you decide to go ahead with this option, then what was your second best option, which was to buy a bond that was earning you 5% rate of return or 5% interest rate? So when you decide to go up with the first option and give up the second option, then the opportunity cost of spending the 10,000 today would be the return that you have actually given up, or the interest that you have given up is 5%. So in this case, we may also call interest rate, that is the 5%, as the opportunity cost. So depending upon the context, you can interpret interest rate in different ways. As we said, number one, required rate of return. Number two, discount rate. And number three is actually the opportunity cost of capital. All right, let us look at our next topic, which is components of interest rates. That's our next topic. If I take you back, we said the minimum return that the investor requires is a compensation for time effect, and that is called real risk-free rate of return. And if we are in a world in which there is inflation that causes your money to lose its value over time, you also want a compensation for expected inflation. Likewise, if there is a risk on your investment, then you would also demand a risk premium, and the higher the risk, the higher the rate of return. So we've already sort of looked at the components of interest rates, and we'll now elaborate on them again. So the first component of interest rate is real risk-free rate of return, which is a compensation for the time effect. Let's suppose this compensation amounts to about 2%. So 2% is the real risk-free rate of return. If there is inflation, you also want an inflation premium or expected inflation. Say inflation is expected to be 1%. When you add these two numbers, the result that you get is called nominal risk-free interest rate. And you can spot the difference between real risk-free and nominal risk-free interest rate. That is, real is excluding inflation compensation or inflation premium, while nominal is including the inflation premium. So whenever you see the word nominal, that means it includes the inflation premium as well. And this is what you would require from a risk-free investment, which is a compensation for the time effect as well as a compensation for inflation effect as well. As we said, you also would want a compensation for risk premiums. And now we break the risks down into three different types of risks. The first one is called default risk premium. Now, what is default risk? The default risk is defined as the risk of the borrower not being able to pay back the interest and principal on the loan on time. So the risk that the borrower may not be able to pay back the interest and principal on time is referred to as default risk. Of course, not all entities have the same level of default risk. Some will have more default risk while others will have less default risk. And default risk is reflected in credit ratings of the entities. So let's say in our case, this is 2% premium. So far, the return that you would require would be 5%. We also have other types of risk premiums or risks. The next type of risk we have is liquidity risk premium. Again, what is liquidity risk? Liquidity, generally the term liquidity refers to the ability to convert your investment into cash. That's what liquidity means. And what is liquidity risk? The liquidity risk is the inability to convert your investment into cash. You need to know that there could be different terms that could be used. For example, we say liquid investments versus illiquid investments. Liquid investments are those that are easily able to be that you can easily convert into cash, while illiquid investments are those that you would actually find difficult to convert into cash. As a result, you would have to offer price discounts when you are actually selling, which would sort of be a loss for you in order for you to convert your investment into cash. Let's say if you buy a property in a very remote area, if you are investing in a property and you have two options. Either invest in a very remote area or in an urban city, and the property in an urban city is very liquid. There are a lot of buyers and sellers. Hence, it will be far easier for you to sell your property as opposed to the property that you would buy in a remote area. So the property in a remote area will have more liquidity risk, and therefore you would demand a higher premium to compensate you for the price loss that would arise when you would actually be selling your investment. So let's say that is around 3%. So our investment is quite illiquid, meaning the liquidity risk is actually higher. Finally, the last one is maturity risk premium. Now, you could think of it in this way, that let's say if you have two options to choose from, you have a 10-year bond that you could actually buy, or you could buy a 20-year bond. So which one do you think would be more riskier? You might think of, obviously, 20-year bond would be more riskier, and that's correct. The 20-year bond is more riskier because it has a longer maturity, but the precise reasoning behind why 20-year bond will carry more risk is what you will understand once you go through the fixed income topic, where this would be covered in a lot more detail. But let me put it this way, I'll just give you a brief idea for why it's more risky. Of course, you should come back to this after you go through the fixed income topic. So long-term bonds, their price often is a lot more sensitive, or is more sensitive than short-term bonds to interest rate movements. So when interest rates tend to move, you will often find that long-term bonds prices would often move a lot more than short-term bonds. Therefore, long-term bonds are more riskier than the short-term bonds. And in our case, let's say this is around 2% again. So what have we said so far? If it's a risk-free investment, this is what you require. If it carries risk, you would add all the premiums for the different types of risks. When you add all this up, the total return that you require, or the total return that you get, as in this case, you see, so that's around 10%. This is called your required rate of return. You may also call this as RRR, and this required rate of return would also be the discount rate that you would use to discount the cash flows. All right, before we get started with calculation for present value and future value and the rest of the reading, we need to discuss the calculator, the functions in the calculator, some core finance functions, and some generic functions that you need to know because they will really help you perform the calculations really quickly. So we'll be discussing these tools and functions that you actually have in your calculator. So let's talk about some general stuff that you have in your calculator. Of course, here is your on and off button that you would actually press. And right at the bottom left is your clear work button. So if you want to clear whatever work or calculation you have done on your screen, whatever appears on your display, you can just press the clear work, and you should get used to pressing this button twice in order to clear your screen. All right, as a first thing, as soon as you open up your new calculator, brand new calculator, what you should do is you should actually convert your decimals. By default, you will always find that your calculator will be in a 2 decimals. That means it gives you answers in 2 decimals. But at times you need more than 2 decimals, especially for calculations related to, for example, currencies. You know, you need at least up to 4 decimals. So ideally, it is more appropriate to have something called 9 or floating decimals. Floating decimal is where the calculator would adjust the decimals according to the calculation itself. So sometimes you're getting 4, sometimes 6, sometimes 8, and at times 2 or 1 as well. So how can you set your calculator from default 2 decimals to 9 decimals? One thing, for those of you who have used other calculators or scientific calculators or Casio calculators, you would be aware of a key which is basically shift, or even in your laptop keyboards, you would also often find shift. And in the calculator, if you want to use any function that is right above the key, above the button, for example, what you see above 0 is MEM, which is memory, which stands for memory. If you see above the decimal key, you will find format. So if you want to actually enter into the format or use the format function, then you need to press the shift, or you may call it the second, which you see right here. All right. So whenever we want to use any function above, we need to press the second or the shift first. So we go back to how to convert from how to convert to floating decimal. So how do we do that? How do we convert into floating decimal? Well, here's what we do for that. We will press second. So you'll press second, followed by the decimal button, which is the format button right there. So this is your basically decimal. or your format button. When you press second and format, what you would see on your display screen, your display screen, you will see right here, it would say DEC equals 2. That's what you will see by default. So as soon as you press second and format, you should see DEC equals 2. That means you have 2 decimals. That's why your calculator gives you answers up to 2 decimal. And we want to make it floating decimal. So the calculator has been set in such a way that if we replace the 2 with 9, 9 represents actually the floating decimal. So all you should do is, after pressing this, you should just simply press 9, and you're not done yet. You need to enter this. You have just entered it. You need to make sure that it's properly entered. And for that, you need to press the enter button. As soon as you'll press enter button, you should see an equal sign next to 9. So make sure you press the enter button after pressing 9. And now you can press the clear work, and you can actually clear the screen, and your calculator has been set to 9 decimals. You can do any calculation, and you will find that your calculator is basically in 9 decimals. All right, the second thing we are looking to do in our calculator after this is converting from CHN, which is chain rule, to AOS, which is algebraic operating system. All right, so what is this? Let's understand it through an example. Let's say we have 5 plus 3 times 4. And think about it, what do you think is the answer? So oftentimes you will get 2 different answers. So you will see some people giving one answer and others actually giving the other answer. And here is how you can look at it. If we use the chain rule, which is CHN, according to the chain rule, you should go with the chain. So you will go in order. You will say 5 plus 3, which is 8. 8 times 4 is 32. So according to the chain rule, we should get actually 32. The answer should be 32. And if you try to do this calculation in your calculator right away by pressing 5 plus 3 times 4 and then pressing equal, you should end up with 32 by default. That's how brand new calculators are set to be. They're set to be in chain rule. But if you know, in school, we've been taught to use algebraic operating system. And on algebraic operating system is based on what we call BODMAS rule, which is what is the order that you should be following whenever you have an algebraic equation? You should begin with brackets. You should always try to solve brackets. Then order of. D stands for division. You should always solve for division first. Then multiplication. So then you multiply, and then you add, and then you subtract. So first you should do division, multiplication, addition, and subtraction. And of course, you begin with bracket and an order of this. So if using algebraic operating system, if you try to get the answer, we should get a different answer. We will first try to, in this equation, we'll try to multiply first before we actually add. So if we try to multiply, we get 4 multiplied by 3 is 12. 12 plus 5 is actually 17. So according to algebraic operating system, the answer should be 17, which generally is assumed to be the correct answer. But your calculator, when you try to do the calculation, actually gives you 32. So how do we switch from CHN to AOS mode? And here's what we do. All we do is we press second, followed by decimal again, which is the format right here at the bottom. And again, you will see DEC, which is the decimal on your display screen. You press the down arrow, which is right in the very first row. And I have highlighted it right here for you. Press the down arrow once. You press the down arrow twice. You press the down arrow third time. And you press the down arrow fourth time. And when you will press it, you will now see on your display screen, if it's a brand new calculator, it should show CHM, which is chain rule. That's how your calculator is set to be. What you should see, what you should do after this, when you have this on your display screen, you should press second and followed by enter, which is right here, the second and the enter. When you will press second and enter, your calculator has now switched from CHN to algebraic operating system. So it will automatically switch to AOS. You can try to do the same calculation again, which is 5 plus 3 times 4, and you will see now your calculator produces 17 as opposed to 32. Now, once you change the mode from chain to AOS, you still need to be a little careful while using the calculator. And here is how you could look at this. Let's suppose if I'm doing this calculation, which is 5 plus 3 times 4, and all this divided by 2. If I try to put this in the calculator by pressing 5 first, then adding 3, then multiplying by 4, and then just pressing. So if I do this, if I say 5 plus 3 multiply by 4 and then divide by 2, the problem is, here is the answer you would actually get. The calculator is perceiving this as 5 plus 3 times 4 divided by 2. While what we want is we want to divide the entire number by 2. So make sure you don't make such an error. You don't write it in this way in your calculator. You don't key in and type in this way in your calculator, which is your Texas VA2 Plus professional calculator. Now, to avoid this, personally, what I would always do is make sure you do the top first and get the result by pressing equal, and then divide that by 2, or alternatively, multiply these two first, do the BOD mass. So multiply these two, get the result, then add 5, then get the result by pressing equal, and then divide it by 2. So in that way, you can make sure that you don't make such a mistake when using your calculator. So far, we have discussed how to convert from floating, how to convert to floating decimal, how to convert from chain to AOS. The third general tool that you have in your calculator is actually the memory function, which is very useful, especially if you get used to the calculator and you practice on the calculator. It could be very handy and it can save you a lot of time. So here's what you can do using the calculator. Actually, you can store a lot of results and you can reproduce and recall those results for further calculations once you need them, or if you have longer and lengthy calculations that you actually need to do. So we'll go through an example of this. Let's say that you do any calculation. Let's say you do 50 times 35. You just type this in your calculator, 50 times 35, and the answer you get is 1750. Suppose I'm going to use this number later on, so I want to store this in the memory of my calculator. So when you look at your calculator, you can store up to 10 numbers all the way from 0 to 9. So that's 10 keys. In these 10 keys, you can store 10 different numbers. And how do you do that? If you look at this key here, which is STO, which stands for store, and you see another key here, right here, which is RCL, which stands for recall. So how do I store this number? Let's say I want to store it in 1. What I like to do is I like to skip 0 because it's more convenient to go from 1 to 3 and so on. So I often like to skip 0 and not store anything in key 0. So I'm going to store this number in key 1. So once I get the result on my display screen, once you have the result of the calculation on your display screen, here is what we do. We press STO, which is right here, and followed by 1, the key 1. As such, you would see nothing happens on the display screen, but something has happened in the background actually. The number has been stored in 1. What you could also do is, let's do another calculation. Let's say 30 times 15. And let's try and get the result, which is 450. Let's say I want to store this in 2. So you press STO and then 2. Now, if I need to bring these numbers back for further calculations, what I could do is I could actually press recall. I could press recall followed by 1 if I want to bring back what I have stored in key 1. I could also press recall followed by 2 if I want to bring back what I have stored in 2. But the interesting thing is, let's say I want to divide whatever I have stored in key 1 by whatever I have stored in key 2. So here's what we could do. We can say recall 1. These are the buttons you should be pressing. So you press recall 1 followed by, and you want to divide that, so you press divide. You press divide by recall 2. So press recall, then 1, then press divide, and then press recall and 2, and then just simply press equal, and that should actually give you the result. You're dividing whatever you have stored in 1 by whatever you have stored in 2, and so on. You can do recall 1 plus recall 2, recall 1 minus recall 2, recall 1 times recall 2, and so on. Not only that, let's say I want to divide whatever I have stored in 1 by 50,000. So I want to divide 50,000, sorry, by whatever I've stored in 1. So what I'll do is I'll key in and type 50,000 in the calculator first, and then I'll press divide by recall 1, and then simply equal. And that should give me the answer by dividing 50,000 by whatever I have stored in 1. So this is a very handy tool. Once you get used to it, you can actually use it for a lot of functions. Likewise, if you just want to bring back whatever was the last calculation that you did and that came up on the screen, on your display screen, all you could do is just simply press second and equal, which is answer, and it should bring back on the display screen whatever was the last number that was actually stored, that was displayed or that was produced on your calculator. You might also be interested in seeing your entire memory. What have I stored in all these different keys? What have I stored in 0? What have I stored in 1, 2, 3? And what if I want to erase the memory? One thing is, you might not want to erase the memory. All you could do is every time you could just actually store the new number on top of the previous number. So it just erases the previous one. So if you have a new number, you can just press STO1 and replace it with the older number. But in case if you want to view and see your memory and then erase and clear the memory, here's how you can view the memory. So to view, here's what you should do. You should press second and 0. If you see above 0, you have memory. And what you will see on your display screen will be M0. M0 is your memory 0 right here. And we did not store anything, if you see, based on what we have done above. If you want to see what you have stored in M1, which is in button 1, which we stored 1750. So if you go down, you will see M1. And this number would be stored in that particular memory. If you go down further, you will see M2, and this is the number you will find there, and so on. And that's how you can view all the memory by just simply pressing the down arrow. What if you want to erase it? So to erase and clear it, so you should press again second 0. Always you need to press second and 0. So you need to be in the memory to erase the memory. So press second and 0 to enter the memory, and then simply after that press second and clear work, which is right here, second and clear work. Now most of the time students only press second and clear work and they assume that it should clear or erase the memory. It won't until and unless you enter into the memory. So you need to press second and 0 and then press second and clear work in order to erase the entire memory. All right, so far we have been discussing the general functions of your calculator. If we want to do the time value of money calculations, then this would be one of the essential rows or the keys that we would be actually inputting. If I take you back to the formula that we produced earlier, and I said we would be coming back to this formula over and over again, which was this: present value times 1 plus R, which is periodic R to the power of number of periods, and that gives us actually the future value. All this calculation, while you need to understand this formula as we produced, all this calculation can actually be done using your calculator. You would just have to input the 3 inputs, which is present value R and N, and you will actually compute and calculate the future value. So as long as you know any of the three inputs, you can get the fourth input. So if I bring you back to the calculator and show you the calculator, notice you have 5 keys here. So you'll have to enter 4 of these keys to get the 5th one. For now, one of the key we would always assume is 0. So you would have to enter your N, you'll have to enter your interest rate per year, or you may call it as yield or interest rate. You will have to enter the present value. We'll keep the payment 0 until it comes later in the calculator. We'll talk about it. And once we know these 4, once we've entered these 4, we can actually compute. You see here compute, which is calculate the future value. We'll press compute and future value, and we should get the answer. So we'll input all these 4 and compute the future value. So as long as you know 4 out of 5, you can always find the 5th one, which will be the unknown. All right. Now, the main thing is to make sure you know how to actually properly enter. Now, let's suppose if I take you back to the example that we did before, which was right here, 100 into 1.05 to the power of 2 equals 110.5. So here's what we did. We said 100 into 1.05, which was R was 5% to the power of 2 equals future value. This was our present value, this was our R, and this was number of periods, and that gave us the future value. If we have to use the calculator, I like to always use the calculator starting from the left, which is starting from N all the way to the right, which is up to the future value. So that is a good way to master the calculator. Start from the left and always input and go all the way towards the right side. So we have the N, we do know the N, and in this case, number of periods is 2. So how would you always enter, how would you input the inputs into your calculator? So we know N is 2, but how do you enter this in the calculator? Here's what you do, and this is extremely important because I often see students and many candidates actually do it opposite. You don't press N first. I repeat again, don't press this first. What you do is you press 2 first, and then you press N. I would repeat this again because I've seen it commonly when you're a beginner and you haven't used the calculator. You should first press the number followed by the key. So what I could do is I can write the order here for you. I'll write the order. First you press 2 and then you press N. That should be the order. You don't press N first and then 2. That's a wrong way of actually doing it. Same goes with interest rate. As you can see, interest rate in this case is actually 5%. And one more point that you should know, whenever we are inputting interest rate or rate of return in a manual formula, we should always remove the percent, because the interest rate was 5%. So we divided by 100 for it to become 0.05. But whenever you are inputting in your calculator, you don't have to remove the percentage because the calculator is aware that it's percent. So all we would do is we would just simply press 5 and not percentage. All right. Again, how would you input this in your calculator? What's the order? You first press 5 and then you press the interest rate key. That's how it is supposed to be. Third, we will input, what is a third one here? Present value. So we will put the present value. And how do we put the present value? Input the present value. We will say present value is equal to in this case, it's not 5 million, it's $100. Just make correction here. Present value is $100. But one thing you need to understand, for the calculator, we are talking about cash flows. You're investing something and then you will get your money back, which is the future value. What you're investing today is going out, that's your present value, and what you will get back in the future is your future value, and that will come in. So because you're investing today and the money is going out, therefore, in terms of cash flows, this should have a negative sign, because for your calculator, at least one will always be negative. There will always be an outflow followed by an inflow, and the outflow should always carry a negative sign. Sorry, it should always carry a negative sign. So we are going to put a negative sign with 100. All right, how would you enter this in your calculator? So let me write that down. Let me write the steps down. First, you will press 100. As I had said before, you'll press 100. then you're not going to press this negative sign right here. You are actually going to press, after pressing 100, you're going to press the plus minus button right here. You'll press this. So after 100, just simply press plus minus. Once you press plus minus on your display screen, you will see a negative sign next to 100, meaning now it's negative 100. And now you need to enter it into PV. So what you will do is then you will press PV. So basically the order still stays the same. You press this first and then actually the PV. And as I said, I'll explain that later. The payment, we will keep it as 0. Same thing, you will just simply press this first and then this. And finally, all you're going to say is compute, which is right here. Press this button and simply future value. And it should give you the answer as 110.25. That's how you actually get your, that's how you enter everything into the calculator. So make sure you practice this really well. One more thing that I would like to add, and that could help you a great deal. Let's say if you have made a mistake somewhere and you want to diagnose your mistake, instead of redoing everything, here is how you can actually diagnose your mistake. All you need to do is just simply press recall and then N. It should show on the display screen what you have entered into N. Similarly, you can press recall and you can press interest rate. You can press recall and you can press present value. And you can press recall and you can press payment. And that should bring back everything that has been entered. So wherever you discover a mistake, you just need to replace that with a new number. For example, if by mistake I had entered payment as 2, what I could do is I'll just press 0 and press payment, and that will just simply replace the previous number. And then I could say compute and future value, and that will give me the answer. So that's how you can diagnose if you ever make a mistake. Another key essential point here is every time you move to the next question, you want to make sure that you erase whatever has been entered in the TVM row, which I call the TVM row right here. So how do you erase whatever has been entered, whatever numbers have been entered? Well, if you read carefully above future value, it says clear TVM, right? So you want to clear this. And how can you clear this? All you need to do is just simply press second and FV. Once you press second and FV, there is nothing that would appear on the display screen, but in the background, everything that was entered here has actually been cleared. And you should do this every time you're moving to the next question. And then once you press recall, and you will find nothing would actually be stored here. I repeat again, make sure you practice this well. And now we'll look at this and this formula as well several times. So let's get started. The best way to approach this reading actually is through examples, and that's what we will be doing throughout this reading. Step by step, we'll be building our understanding through several different examples. So let's read the example. So it says you are the lucky winner of your state's lottery of 5 million after taxes. You invest your winnings in a 5-year certificate of deposit at a local financial institution. The CD promises to pay 7% per year annually. This institution also lets you reinvest the interest at that rate for the duration of the CD. How much will you have at the end of 5 years if your money remains invested at 7% for 5 years with no withdrawals? Very important assumption. No withdrawals, money will be compounded, meaning you keep reinvesting your money each year. So it's compounding on an annual basis. So I'm going to show you how you can get it using the formula as well. A formula is very essential. If you understand the formula well, you should be able to enter your inputs well. But of course, at the end of the day, you will be using your calculator once you attain the mastery. So let's look at it using both the ways. If we use the formula, here's what we would say. We would say future value, because we want to find the future value by the end of 5 years. So it will be future value after 5 years equals present value times 1 plus r to the power of n. In this particular example, because the compounding is annual, therefore r will be annual rate of return and n will be number of years. Keep in mind these are periodic, but in this case we say yearly basis because compounding is on an yearly basis. So present value is 5 million. We don't care about the negative sign if we're doing it manually, times 1 plus r which is rate of return. How much is that? That is 7% to the power of, we want to find it after 5 years, as was mentioned. So n is basically 5, and that should give us the, and your answer is 7.012 million. That's our answer. This is one way. If you're using your calculator, again, make sure you know how to press the keys, starting from left to the right. And in that case is actually 5. Number of years is actually 5. Your interest rate is simply 7%. You don't need to remove the percentage. Make sure you know you should press the number followed by the key. Your present value is 5 million. Since you are investing, you can put the 6 zeros. That's totally fine. Make sure you press plus minus to put the minus sign, and then press the present value. There is no payment right now. We'll talk about this later on. As we said before, you just simply press compute future value, and that should give you 7.012 million right after 5 years. Let's move to our next example. And this is example 2, which says an institution offers you the following terms for a contract. It is willing to pay you a lump sum at the end of 6 years if you invest 2.5 million today at 8% annual interest rate. So what amount of lump sum will you expect in the future? Using the formula, we will say present value times 1 plus r to the power of n, and that gives you future value. We want to find the future value by the end of 6 years. The present value is 2.5 million. That's what you're investing. And the rate of return is 8%. Compounding is on an annual basis for 6 years. And the answer is 3.967 million. Alternatively, we would say n is 6. Interest rate is 8%. The present value is minus 2.5 million. Payment would be 0. You just simply compute the future value and you get this answer. That's how you actually answer example 2. Let's look at example 3. So it says a pension fund manager estimates that his corporate sponsor will make a 10 million contribution 5 years from now. The rate of return on plan assets has been estimated at 9% per year. So what we have been told is 5 years from now, there'll be a 10 million contribution, right? So after 5 years, there will be a 10 million contribution into the pension fund. And then it will be invested. Once this contribution is received, this will be invested. The rate of return is 9%. The pension fund manager wants to calculate the future value of this contribution 15 years from now. So this is time 0, which is time now. 15 years from now, right here. And we want to find what will the future value be. That exactly is what is the question. Now, notice, is our money being invested for 15 years or 10 years? The contribution comes at time 5, and this is when we actually make the investment, and the fund actually makes the investment. Therefore, the money would actually grow only for 10 years. Hence, our N in this case would be number of investable periods, which is 10 in this case. So future value would just simply be, if we're doing it using the formula, we would say present value is 10 million. This is what we are investing here, times 1 plus 0.09 to the power of n will be 10, because you're investing for 10 periods. And the answer is 23.673 million. If you're doing it using the calculator, n would be 10, interest rate would be 9%. The present value, make sure you know it's minus 10 million, never forget the minus sign. The payment, which we'll be discussing later, is 0, and you just simply say compute and future value, and that should give you the answer, which is 23.673 million. All right, whatever we have discussed so far was how to find the future value of a lump sum, which is basically a single investment. So we invested 10 million, we invested 2.5 million, we invested 5 million, and we actually found the future value of a single investment in the future with annual compounding. We didn't talk about other types of compoundings. And now in the following examples, we'll look at different types of compounding, such as semi-annual, such as quarterly, such as monthly, daily, weekly, and so on. If it's semi-annual, then there are 2 periods in a year, 2 semi-annual periods in a year. If it's quarterly, then there are 4 quarters in a year. If it's monthly, you have 12 months in a year. If it's daily, you have 365. If it's weekly, you have 52 weeks in a year. So you need to remember that periodicity. All right, let's look at example 4. We said your bank is offering a 2-year CD maturity at 8% interest compounded quarterly. As I mentioned, interest rate by default will always be annual, but it's compounded on a quarterly basis. So this 8% is not per quarter, rather it's actually per year, and we need to adjust it. And will be reinvested at the same rate. So if you invest 10,000, what will the CD be worth at maturity? Going back to what we said before, R in this case, what is N in this case? N in this case will be number of periods, and we are counting the periodicity as quarterly, so N therefore will be number of quarters. And R will not be the annual rate, R will have to be the quarterly rate. What we have been given is annual rate, and we have been given the duration in years, not in quarters. So we need to write the N in quarters. So 2 year corresponds to 2 times 4, because you have 4 quarters each year, will give you 8 quarters. So N is 8 quarters, while R will be quarterly rate, while we have been given an annual rate. So how do we do that? In this case, we will divide 8 by 4, and that gives us 2% per quarter. So we have adjusted both N and R, because both of these are periodic, to basically, we have made an adjustment from annual to quarterly adjustment. All right, and this is what we would actually be using in our calculations. So that's extremely important. Make sure you know the basic calculations here, how to make the adjustments. For N, we are multiplying. For R, we are dividing, because we want to bring it down from annual rate to the quarterly rate. If it was semi-annual, of course, we would have to divide it by 2, because from annual, we need to bring it down to semi-annual, which is 6 months. If you are drawing the timeline, here is how it will be. At time 0, we are investing $10,000, which would generally be our present value. And we want to find the future value by the end of 8th quarter. So what is future value by the end of 8th quarter? That is what we are actually looking at. And in this case, as we said, was 2 times 4, which will be 8. We will input 8 in our calculator. Interest rate, as we said, will be 8 divided by 4. We will input 2% in our calculator. Payment, as before, we will keep it 0. And all we would then do is simply compute and future value, and this should actually give us the answer. If it's quarterly compounding, it should give us 11,716. That's the answer. If you're doing it using the formula, you would just say present value times 1 plus quarterly rate to the power of number of quarters. So that's extremely important, right? All we would say is 10,000 times 1 plus 0.02. I've already divided this by 4. So I'm assuming, otherwise you could also press 0.08 divided by 4. To the power of number of quarters, how many quarters are there? It's 8 quarters, and that should give us 11,716. All right, our next example is on a monthly basis. So it says an Australian bank offers to pay you 6% compounded monthly. You decide to invest $1 million for 1 year. What is the future value of your investment if interest payments are reinvested at 6%? So because it's monthly, we're going to count in terms of months, and the periodicity is on a monthly basis. So N in this case will be number of months. And since we want to find the future value after 1 year, in 1 year, how many months are there? 1 multiplied by 12 is 12 months. Right? So make sure you know this is on a monthly basis, while R, it should be the monthly rate. We have been given annual rate by default, and we divide it by 12 to get monthly rate, which is 0.5%. That's our monthly rate. And now simply if we draw a timeline, here is what we are saying. After 12 months, we're investing today $1 million. How much would it become after 12 months? Make sure not to forget the minus sign because we are actually investing. So if we are using the calculator, we would say interest rate is 0.5%. How do we get 0.5%? We divide 6 by 12, and that gives us 0.5%. We know the n, which normally I write first, is 1 times 12 is 12 months. We will enter 12. The payment, 0. Simply compute future value. And you should get 1.061677. That should be your answer. If we're doing it using the formula, we would say present value times 1 plus r to the power of n. R is going to be monthly rate. So we would say this is 1 million times 1 plus 0.005, cause it's 0.5% to the power of 12. And that should give you the same answer. All right, so here's what we have been discussing so far. We have covered all these examples. We have looked at future value of a single investment, which is a lump sum. And for future value of lump sum, we have looked at number 1. We have looked at annual compounding, where we are assuming that the returns are credited on an annual basis and then reinvested on an annual basis. We have looked at semi-annual, where the periodicity each year is 2. We've looked at quarterly. We have looked at monthly, where the periodicity is 12. You can look at weekly, where it's 52, which means every week the return gets credited to your account and you reinvest it. That is how it's compounded. And we looked at daily as well. Daily compounding, where the return gets credited to your account on a daily basis. All these compoundings are called discrete compoundings. All these are actually discrete compoundings because you can count the number of times it will compound in a year. With semi-annual, 2 times, quarterly, 4 times, monthly, 12 times, and so on. But there is also something called continuous compounding, whereby the money keeps growing. The money keeps credited. The money is credited to your account all the time. It's on a continuous basis and gets reinvested on a continuous basis. Hence, the number of compoundings in a period or in a year cannot be counted because it is happening, it's growing all the time. So while in all these 6 cases, we can count the number of compoundings or the number of periods or the number of times our money gets reinvested, in the case of continuous compounding, you cannot count the number of times your money would actually be reinvested or compounded. Now, the problem is students tend to think that when we speak of continuous compounding, the n is infinite. The n is not infinite. You know that you're investing for 3 years or 4 years, but the number of times it will compound in those 3 years or 4 years is something that is infinite and you cannot count that. So it's the number of compoundings in a particular period that becomes infinite. So you need to basically know that, and that's an important point to be aware of. All right. Having understood this, we'll talk about this now, and we can't use our calculator to get the answer for continuous compounding. I would like to go back to what we have already discussed so far. We have discussed the following formula for discrete compounding. We have said that future value equals present value times 1 plus r to the power of n. So at the start of this reading, I said, where does that 1 come from? And we said 1 is used as a base number. So it's assumed as if you're investing $1 today, which means this is your present value today. Then this part gives you, if you notice, your $1 grows at r for n number of periods. And hence this part gives you future value of $1 investment grown at r for n number of periods. In short, we can say this part of the formula just simply gives you the future value of $1. And if I can have the future value of $1, I can get the future value of any dollars. That is, we multiplied by the present value to get our future value. So that's an extreme important understanding that you should have, and I assume that you already know from the start when we actually discussed this. When it comes to continuous compounding, here's what we do. We use this particular formula, which is the expression, which is simply future value equals present value times exponential function for continuous compounding to the power of r multiplied by n. Before I talk about what result this would actually give to you, let's first understand what is R in this case. So R in this case is annual rate of return. We use annual rate. Previously, we said R was quarterly rate, monthly rate, weekly rate, daily rate. We could count it, but since we can't count the number of compoundings, we are going to use annual periodicity here. So R should be annual rate, and N will be number of years. All right, and you know, whenever you are using an expression like this, you have to remove the percentage from the interest rate. So if R is 5% continuously, then this would be 0.05. All right, having understood this, now what would this mean when you calculate this using your calculator? What would it mean? What would be the result that you would get? The result that you would get would be very similar to what you see here. Just like that gives you future value of $1 with discrete compounding, this would simply give you future value of $1 with continuous compounding. So all it is future value of $1 investment grown at R continuously. So it grows continuously for n number of periods. As simple as that. So this would give you the future value of $1 that has grown continuously for n number of periods at this rate of return. You just simply multiply that with any dollars that is present value, and that should give you the future value. I'm going to show you how to use your calculator for this. All right, to use your calculator, so I'm going to illustrate the use of calculator through this example. So let's look at this example. It says, suppose a $10,000 investment will earn 8% compounded continuously for 2 years. What is the future value? So if we use the formula, it's future value equals present value times exponential to the power of R multiplied by N. R in this case is 8%, while N number of years is actually 2. So all we would say is 10,000 times exponential to the power of R is 0.08. You remove percentage times N in this case is 2. So we would just press simply 2. So how are you going to use the calculator? First, to use the calculator, you're going to press 0.08 multiplied by 2 and press equal. So let's get the answer. 0.08 multiplied by 2, you should get 0.16. Once you have 0.16 on the display screen, here's what you should do. You should press second and ln, which is the natural log button to the left of 7. You will find this button to the left of 7, and when you will press that, and you can clearly find on this button e to the power of x. When you will press that, the answer you should get is 1.1735. All right, so that means this is equal to, this is the future value of Enmity, 1.17. I'm sorry, this is the future value factor, just a small correction here, times the 10,000. And that should give us 11,735. That's a future value. Now, the main thing is I want to focus on what does this mean? Remember what we wrote here? Future value of $1 investment that grows at R continuously for n number of periods. So here's what we will say. This is the future value of our $1 investment that has grown for 2 years continuously at a rate of 8%. So after 2 years, your $1 becomes 1.1735. This is the future value of $1. If I could have it for $1, I can get it for $10,000 as well. and that gives us 11,735. All right, before proceeding further, let me give you a quick overview of what we have covered and what is actually coming up. So we have discussed so far future value of lump sum with different series of compounding. So we have actually looked at, let's suppose if I invest a certain amount, let's say I invest 10,000 here, how much would this 10,000 become, say, after 5 years? And that's what we have answered with different compoundings. So we have discussed with annual compounding, we have discussed with semi-annual compounding, with quarterly compounding, with monthly compounding, weekly, daily. All these are discrete, and then we also discussed continuous compounding as well. Right? That's our first topic that we have actually looked at so far under this section of future value. Our second topic is future value of enmities. While I'm going to elaborate on this when we get into it later on, just as a quick difference, here is how you could look at it. Let's say if I'm going to invest each year $100, so I'm investing $100, $100, and $100, how much would this become by the end of third year? So if I'm investing an amount equal to $100, 3 payments of $100, how much would they be worth? And this is what is called an annuity. We'll look at it and we'll define it later on. Our third section is actually going to be future value of unequal cash flows. Right, so that's our third section. And here is how you can look at it. You're investing 100, 150, and 190. How much would this become right by the end of third year? That is what we are actually looking to find. So these are the 3 sections we would be discussing under future value, and almost the same sections would actually be covered under the present value as well.